Good morning. This is Mary Copeland. Welcome to the Kitsap Provider Breakfast Group. We have a special speaker today, Rebecca Rainsberger of American Advisors Group, and she is a reverse mortgage specialist that truly cares about those that she serves. And she's here today to do a presentation to us. So welcome, Rebecca.
Thank you, Mary. Yes, reverse mortgage. What interesting and very unusual term. A reverse mortgage itself has had a bad rap for a long time, and it's mainly because of how. Oh, I thought I turned my phone off. It's mainly because of how reverse mortgage started in the 60s, late 60s or early 60s, and it was not an FHA insured loan then. It was a loan that prices were crazy. People were getting forced out of their homes eventually. There were so many bad stories to be told. And people remember bad stories. They don't remember changes and growth and positive. It's like we only remember the negatives, it seems like, the dramas. There should be a book of history of the great things that happened over the years. But in my world, I constantly am saying it's not like it used to be. It's very different. Well, in the late 80s, FHA, Federal Housing Administration, looked at what was going on with seniors doing that reverse mortgage loan, and they thought, this is not fair to them. This is taking advantage of seniors. So they started working on maybe coming up with something similar. And they came up with home equity conversion mortgage. That's the real name of anybody doing an FHA loan right now in reverse mortgage. But nobody could remember that name, home equity conversion mortgage. And people in the business called it the Heck'em loan, but nobody knew that either. So it just was kind of came upon us to say it's FHA's new reverse mortgage. Then they go, oh, it's kind of like that, but it's not. It's very different in a lot of ways, and it's very protective of seniors by far. So just so you know, a lot of folks, when they're going, oh, don't do reverse mortgage, it's there, take your home. It's so different now, you guys. And legally, when they do the paperwork, it says home equity conversion mortgage. But like everybody else, we also come to the quick nickname, reverse mortgage. So it's similar in one way. It's a mortgage. It's using the equity of your house. Home equity line of credit, you hear that at a bank, getting, the equity in a loan. It's somewhat similar in some ways, but the big difference is with a reverse mortgage, there are no payments. You pay off the loan when you leave the home permanently. And that means your loved one, say it's a relative, they would either pass away and the heirs would inherit this house and they would pay off the loan to keep it, or they would sell the house and pay it off and get the remainder of the profit. Now that's like it is with any mortgage. If your grandmother passed away and you inherited the house and she had a mortgage, to keep that house, you need to pay it off. Or sell the house, pay it off. Same thing. But reverse mortgage, home equity conversion mortgage through FHA, made this loan a non-recourse loan, which means you never owe more than your house is worth. If someone got a reverse mortgage and there's no rules of when you have to pay it back. It could go way beyond a 30-year loan. It might be 40 years they're in that house. Let's just say, you could be 140 and not owe that loan. The loan goes to 150 years old. But if you live past 100, let's say, or 110 years old, and you did a reverse mortgage when you were 62, okay, that's many years. This non-recourse loan means you never owe more than your house is worth. So through the time of having this reverse mortgage, you're not making any payments. That's why it's called reverse. It goes the opposite. You owe more at the end than owing less at the end of the loan with a traditional mortgage because you're making payments. So in the reverse, you owe more at the end. Well, say your grandma owed $350,000 and her home at that time when you tried to sell it, it was 320. Her house didn't go up much in value, or we were in a big foreclosure time, market crashed and the housing values went down. You do not owe anything. You could walk away from that loan if you inherited it. That's what a non-recourse loan is. You never owe more than your house is worth. Now in Washington state, it's very rare for houses to go down in value. So that's what I'm kind of lucky here. Most people are West Coast, pretty much houses always go up. But Washington in particular has been great. So it doesn't happen that often where someone has their home go down in value over what they owe. But just so you know, it's not creating a new debt for your heirs. They could walk away from it. Okay. So that's one of the big changes that most people don't understand, non-recourse loan. A lot of other myths are common things like thinking they don't own their house anymore. They think they're the bank. They think we own their house. No, you stay on title. You're still the control person of what you're going to do. If you're going to sell your house, you're going to move, or you're going to keep it, whatever. There's no rules in the world of reverse mortgage of us owning the house. There's nothing like that. The only big rule is you have to stay current with your home insurance and your property tax payments. If you don't, FHA could put the house into foreclosure. So that's their big red flag. Property taxes, home insurance. So there are folks out there that worry, I'm getting old, I might forget. What if I forget my homeowner's insurance payment? Maybe you should then put it in the loan, and we can do that. We can put their home insurance and property taxes into the loan. But that is a big red flag. Keep your house normal. You have to have home insurance. So if your gutter fell down, you would need to get your gutters put back up. Your home insurance probably will help you pay for most of it, but you need to have money, not of gutters. Blair's going, no, they won't help with that. Let's say there was a fire. Okay, there you go. But you need to do the basics, use your home insurance, but have a little bit of savings to help pay for these things that happen to our house over time. It can really need a little bit of repair. So the type of repair I'm talking about is, like I said, a gutter in Washington, it happens. The gutters fall down. Chip paint, Washington State, a lot of rain, chips your paint. Get your house painted. Don't let the water seep into the wood and have dry rot in your shingles, dry rot on your deck. Little things like that. Just water heater breaks down, you got to get it fixed. Okay. What if your electric system had a problem, or your furnace? You want to get those things fixed. That's it. We're not talking about upgrading, getting a new granite kitchen countertop. It's nothing like that. It's just the health of your house. Okay. So those are the only big red flags that people think we own the house. We don't. We just want you to keep your house in a decent shape, basically. The qualifications for this is also changes have been made. You used to have to be, everybody had to be over 62. If you're married, you and your husband or spouse would both have to be 62 and older. Now it is, you can be 62 and married to a 52-year-old, no problem. We have something called a non-borrowing spouse. So it used to be you had to take that person off title to do the reverse mortgage. Now you don't. we do it, we work with that, and that non-borrowing spouse stays on title. It's the only thing different, you know, if you have a person that's not 62 on the loan, is that person under 62 cannot pull money, use the extra money available in a reverse mortgage, if there is extra money, after the person passes. So let's say a scenario here. A couple, 52 and 62, did a reverse mortgage and they're paying off their existing mortgage. They didn't own their house outright. They had a debt. And that debt, that mortgage debt is, say, let's say it's about 30% of their equity they still owe. So we pay that off. It's mandatory. We have to pay off existing mortgages. That's the one rule. But people who own their home outright can do the loan as well. They'll just have quite a bit more money available to them because we're not paying any mortgage off. So anyway, when that happens, a 52 and a 62-year-old doing this loan, we would pay off that existing mortgage, and there might be money left over. There surely would be another 20 to 30, 20, you know, about 10 to 15% of their equity of their home available to them. And they can pull that money out when they need it, or they could have a monthly income for life, or they could have a term. Maybe they know they're going to move to Arizona in 7 years, so they only want monthly income for 7 years before they know. They just know they're going to move. So all that money that's available, it will always be available when that 62-year-old is alive. But say they pass away when the person is only 65, and then that other borrower is only 55 then. They're not 62, so they cannot pull that extra money. They can stay in the house for the rest of their life. When they turn 62, they should refinance the loan. And you can on a reverse mortgage. You can refinance it. And a lot of people do. That's why I'm so busy. Some people they know their home is higher in equity, so they just refi to have more money available for them. So anyway, that's another little usually fear that people think, I can't do it. Only I'm 62, my spouse is 52, or, you know, under 62. They think they can't do it. They can. It's worth the question. You know, some folks are on the verge of worrying about foreclosure because they can't make their mortgage payment. This might be a solution for them. Other reasons why people might do a reverse mortgage is for in-home care. They don't have a large mortgage, or maybe they do, but they still know they've got quite a bit of equity, and they would like to use that money and not have any mortgage payments. With a home equity line of credit in your bank, you're making payments. With the reverse mortgage, there are no payments. So they sometimes do this for in-home care options. They want to stay in their home. I mean, my clients are the kind of clients that say, drag my feet out first. I'm never leaving this house. So sometimes they might, when their loved one, their spouse passes, they might consider leaving. But usually my clients are the kinds that want to stay in their home. So in-home care is perfect for them if it's ever needed. So I have clients that do exactly that. They get their equity to pay for in-home care. And over time, their care grows. They need more care the older they are, let's be honest. It's just kind of what happens. And they might refinance to use up more equity a few years later to keep continuing to pay for that in-home care. I have other clients doing it for modifications in their home. They might want to make their home wheelchair friendly because their spouse is now in one. I've had it happen, building ramps over the stairs, widening the doors, making that first floor more like a master bedroom. If they're in a 2-story house, all kinds of things happen. That's fine, totally fine to use the money in whatever way you want. I have people buying an RV. They want to travel in their retirement. So they did the reverse to buy an RV. The only rule is if you do have an existing mortgage, we have to pay it off. So then there's the question of, well, how much money do you get with a reverse mortgage? Well, it all depends on your age, number one, because the older you are with reverse mortgage, the more money you receive. So let's say a 62 versus 92-year-old. That's a pretty big difference. But I'm just showing you, and you can figure out this range. But if someone were 62, they would pretty much have to have at least 60% equity in their home. If they're 92, they only need about 40% equity in their home to qualify. The older you are, the more money you receive. So the older you are, almost like the larger your debt, you know, if you had a mortgage to pay off, the easier. So here you go. If you wanted that mortgage paid off, and that's the main point, just to be able to have that, whatever your mortgage payment is, put in your pocket. I mean, I have clients that save $20,000 a year. Some save $30,000 a year not paying their mortgage. That's their choice. Some folks need that money for a different reason. They don't even have a mortgage and they just want money for, you know, modifications, in-home care, vacations. Some people buy a second house. And there's no rules about that. You can do whatever you want with that money, the extra money. So I've had folks actually do that. I had one gal buy her her granddaughter. They put the money down on a new house for her graduation gift from college. Another one gave the money to his son because he knew that his son wouldn't want his own house. He wouldn't want to inherit that house. He wanted his own house. So he took the money to actually give to his son while he was alive and watch him get his house going. So there's all kinds of rules. I mean, there's all kinds of reasons people do the reverse. But the only one, if you're worried about it, it's if you do have an existing mortgage, we do have to pay it off. So the age is one of the reasons, how we figure out how much you're qualified for. The rate, you know, like regular mortgage, the rate goes up and down, but it's not the same scale as regular mortgage. Ours is a little different. So what happens is once a week, every Tuesday, I get a new rate list. So I can't always tell you exactly how much you've received because it changes weekly. Right now, it's great, I'll be honest. 2021 is a great year for refinancing, really for anybody, and your regular mortgage too. But your home value is the third point. So your age, your home value, and the rate determines how much you receive. There is a cap the FHA created on home value, the max claim. The max claim amount on a regular reverse mortgage is $822,375,000 value. So if your home was appraised for $900, in our mind, in our books, it's going to say $900 is your home value, but the loan max claim is $822,375. But if your home is appraised for $700, our paperwork would all say $700,000. I just want to give you that idea. Everyone has different home values, or people they're thinking of might be interested in reverse. Max claim, $822. When I started in 2007, it was $417. Doubled. Anyway, we also do jumbo loans. I have people that have homes over 1 million. 1 million to 4 million is the range we work with what we call Advantage. It's a nickname is jumbo loans. Those homes, you know, they get quite a bit more money, but much higher rate. Our rates right now, for example, on a regular traditional home equity conversion mortgage, you know, it's going around 3.2 to 3.5, something like that in the variable world. In the fixed, we do have that as well. Fixed rate, it's about 3.9. So, you know, you get more money with the variable rate. I'll be honest, about 20% to 30% more money when you choose variable. But the point here is you're not making payments. So some people go, oh, I only want fixed. And that's fine, we can do it. But some people go, wait a minute, I'm not making any payments, so I don't really care if it goes up and down. So I'd like 30% more money. So everyone's different, we can do that. And I can even help $1 million homeowners. Their rates are between 5.9, 6.9, so it's up there. So overall, let me make sure. The big red, I'll go over the pros and cons in a minute, but I'll tell you the biggest shocker about reverse mortgage is the reverse mortgage insurance premium. FHA is really the governing force of this loan, right? They have a mortgage insurance premium in the loan. Now, anybody ever working with a regular FHA loan, they know that term, mortgage insurance premium. That amount is so much greater than a regular mortgage. And they go, this is way too expensive. Well, this is also an FHA non-recourse loan. This amount of money that's put into 2% of the home value, that's in the closing costs. It's all put into the loan. But that one time done, once that amount is paid off, if they did a refi with time every 2 years, every 3 years, it's almost down to zero the second time. There's no mortgage insurance premium usually, depending on the home value and the growth of the size of the loan. Mortgage FHA does not want to keep charging every time you refi. So it goes down to almost, I mean, half of my clients, it's zero when they refi their reverse mortgage. So that big red flag is what fears most people when they see the quote. That's ridiculous. Well, it is rather high, but that amount of money is protecting homes across the nation that let you walk away from this loan without paying it off if your home was appraised for less than you owe. It's a non-recourse loan. FHA does one more guarding point for seniors. You have to be 62 to do this loan, at least. You have to go through a HUD counseling, housing urban development counseling, with a person that doesn't work for a bank or doesn't work for an investor, and talk to them about this reverse mortgage concept, just to make sure that someone like me is being strictly honest, straight up, telling them everything. They want to make sure that I'm not making some story up of oh, don't worry about this. And if I never mention about home insurance and the property tax payments, that would be a problem. So they're guarding seniors. Not everybody gets somebody face-to-face like me. I meet my clients, go into their home and everything. There are people in the United States that don't have a local person, and they're doing it with someone on the phone. So it's great to talk to somebody else. They make you do this. It's mandatory. They have to talk to a HUD counselor. And those counselors look at the paperwork the loan officer gave them. We have to send it to their counselor. There's about 15 to choose from across the nation, companies that do it. And they're looking at that paperwork, making sure Mrs. Smith understood it. And I, for example, explained it clearly. So that's another guarding tool that FHA put into this. Okay. All right. Oh, here's another one. If you're worried, like, well, how would the loan ever become due? Besides you personally leaving your home, if you moved, if you passed away, if you were placed in a nursing home permanently. If it's just you doing this loan and you're put in a nursing home, or, you know, skilled nursing or even assisted for life for the rest of your life, then you're leaving your house permanently. So the loan would be due. The person has about a year with good communication with FHA and the servicing center. They can have a year to pay off this, you know, figure out what they're going to do. Are they going to sell? Or are their kids going to pay off the loan and keep the house? What do they want to do? And same thing if you passed away, the heirs have about a year if they have good communication on how to, you know, what they want to do. If they're going to sell the house, they need some time. If they have got a lot of siblings, they're all fighting about what are we going to do, it might take some time to settle. What should we do? Should we pay it off, keep it, or should we sell it? So that's the main story about the end of the loan. Some folks ask me, what kind of house? Is it only a single family residence? No, it's not. We can do approved condos, FHA approved condos, or FHA single unit approval condos. That's a tricky one, but if you have any questions, call me on that. We can do a two to 4 unit property as long as my client is living in one of those units, of course. Townhomes we can do. FHA approved manufactured homes, also we can do those, and modular homes. The ways to receive money I mentioned earlier, it can be money, you have to pay off the existing mortgage, but if you don't have one, there might be this money. How would you receive it? Well, there's about 5 different ways. If you chose a variable rate, you can have money in a line of credit that grows, guaranteed growth. Right now, it's about 3%, growing. So if you're just sitting there, not having to make that mortgage payment anymore, and you kind of like this emergency fund growing, it's a peace of mind for so many of my clients, just knowing, like a piggy bank, it's sitting there growing and growing and growing, much better than a savings account in a bank. It's growing 3% guaranteed. And you draw from it when you need it. But that one is like a good, you know, if you don't have a good savings account, aren't really planning on annuity investments, or you never did that, it's like a saving grace for some people, this line of credit. Otherwise, there's monthly income. You can have it till until you pass. And our mark is 150 years old. And then there's also that monthly income for a period of time. And then people do sometimes a combo. They want a little bit of cash up front, buy a new car or something, and leave the rest in a line of credit. You know, there's a combo. The fixed rate, however, which is about 30% less money, is only cash up front. You have to take it all up front. Pros and cons. All right, cons. Your heirs will not receive as much money as you planned on. Your house, you were going to leave the kids the house. That's the inheritance. There still will be profit most likely in Washington, but it won't be as much if you did a reverse mortgage. That's a con. If homeowner was indeed going to sell their home soon, reverse mortgage might not be the best point. You know, at almost 15 years, I've had one client, I knew they were selling their home. They did the reverse to get money to fix their home. Because of they could get a home equity line of credit for modifications from a bank, but they did not have good credit. So I can even help some folks. This credit's not great. I can still help them. And this was one of those stories. I had to put their home insurance and property tax into the loan, but they needed enough money to really upgrade their house. They just felt like it had to be done. So they did that. Another con, reverse mortgage does not offer tangible benefit. Right. If your goal is to only rid yourself of monthly payments, you know, that might not be enough. I have plenty of clients that do that because that monthly income is, you know, really could be in their pocket and they could buy more groceries. I mean, I have severe situations that I can see what their living situation is. And if they just didn't have to make that mortgage payment, it would change their life. But some people, you know, they got to understand you're not having a mortgage payment. There's not any extra money. all depending on their home value and such. So that's pretty much on the cons. I have quite a few pros, and I'll send you all a list of my top 9 variety of reasons people have done it. I have made up names, of course, to protect the innocent, but I have 9 little stories, if you guys ever want to read them, on what a wide range of people I've helped. Reverse purchase, I want to touch base, and then you guys can ask me questions. There's also a reverse mortgage loan for a purchase. We call it reverse purchase. And that's when somebody 62 or older is buying a new home. And say they sold their house for $500,000, but they walked away with $300,000 cash, okay? And they're thinking, I'll just buy a smaller condo or a smaller house or whatever for $300,000, so I don't have any mortgage payments. That sounds good. But they could buy, truly, if they were 62, they could buy a pretty much a $500,000 home with $300,000 down if they're 62. Now, if they were still thinking, okay, I'll buy a $300,000 home with this $300,000, they could do a reverse purchase and only put down $183,000. We pay the rest, and they could keep $117,000 in their savings account. So that's another option to question for some folks, buying. If you are 70 years old, you receive more money. A $500 home would only need $273,000. So $1 million home, there's all kinds of other options out there, folks. But as somebody 62 buying $1 million home, they'd put down $700,000 and have no mortgage payments. So any questions about that, just contact me. So you guys, I've told you quite a bit. Questions?
I have one. It's Mary, because it's always, you just talked about the types of homes that, dwellings that people can use to use a reverse mortgage for. And when it comes to manufactured homes, if I'm correct on this, it can only be a manufactured home. Let's say if it's on its own property, that you're buying the manufactured home and the property, as opposed to there are these communities that are 55 and older, and there are beautiful, they could be beautiful and they're manufactured homes in it, but the land doesn't go with the building. It's owned by the park. So that one's not available, correct?
You have to own the dirt the home is on. Yeah, we can't. It's like it would almost be like we can't. We have to own. You have to own the dirt, and we can't do purchases on manufactured homes. I can't do reverse purchase. But if that's the only I can do everything else I mentioned, FHA approved condos and townhomes, but manufactured homes is the only one I can't do a purchase with. But if you have someone with a manufactured home that lives in a condo type community where they don't own the dirt, I can't do the loan. Yeah, good call.
Right, but you're saying, like, there was a house we were renting on Bainbridge, and it happened to be a manufactured home, and it went with the land. It was a privately owned house. So that would be something that you could look at, but it's the ones that are in the community where you're only buying the dwelling, not the dirt.
Yeah.
Okay. Yep.
Yeah, the dirt's owned by somebody else, can't do it.
Yeah.
I have a quick question, Rebecca.
Yeah.
So is it only FHA loans, or does VA loan qualify for this, or how does that work?
No, it's FHA. The reverse mortgage is an FHA loan, FHA insured loan. So what do you mean by VA loan?
Can you hear me?
Yeah.
Somebody was calling on my other line, and and it put this call on hold. So what were you saying? I'm sorry.
The reverse mortgage is an FHA insured loan. So you're asking me if somebody was paying off a VA loan?
Yes.
Yeah, I can help anybody. You know, as long if they have a mortgage, doesn't matter where their mortgage is.
Oh, sweet. Awesome. Thank you.
Yeah, sure.
So, hey, what about the scenario that we're working on with the folks in Poulsbo? So
Yes.
that's a great example. And because they had their own business, everything. And when the husband got Alzheimer's, he was taking care of the books and all the money got depleted. So she's kind of like in a between a rock and a hard place, but I know that you have solution.
Yeah, well, it all depends on the home value, what her house comes in at. Those three things: age, home value, and the rate. And I have to pay off the existing mortgage, so we have to make sure there's enough money there to balance it out. And so far, what we guessed on her home value, I was hoping it was more, but I could pay off their existing mortgage. There wouldn't be a lot left over extra.
Because she really needs to get some home care in place right away, so she could private pay that now and get some help immediately, because she's going for surgery and that sort of thing, and she needs someone there for her husband. And
I can rush it. I can totally rush this for her
this is being recorded.
Yeah. Oh, okay. Yeah, we won't say the name.
No, but how long does a rush job usually take? Or I guess what's the standard turnaround?
Well, normally before COVID, it was 35 to 40 days. On a purchase, I can go under, just so you guys know, to meet the needs on a purchase. But a regular reverse is usually 35 to 45 days. Now it's more like 2 months because the FHA appraisers are overloaded. Unbelievable. So, but on a rush, if someone has surgeries or anything like that, we can try and do it in 2 weeks if all the paperwork is accessible.
Okay. All right. Thank you.
Yeah. Anybody else?
Any questions? I love the fact that the reverse mortgage is another source of income, because the biggest asset most average people have is their home, and they don't think to tap into it the way that you can with the reverse mortgage. And I love the fact also that it's if it's upside down, what was the exact word? Not irrevocable, but where they don't pay. If can you hear me?
What term is there upside down?
When all is said and done at the end, if their house value is
if they owe more than their house is worth.
What is that term again?
Well, we call it a non-recourse loan.
Thank you. A non-recourse loan. I love that too. So
yeah, it happens across the nation, and some states don't always go up so high as Washington does.
Yeah. Well, look at that. We're on time today, and we had the most amazing recording. All right, I'll stop it right now here. Thank you, Rebecca. Don't anybody hang up. Thank you, Rebecca Rainsberger. What is your phone number and your contact? Is it in the chat?
Yeah, I started typing and then I started talking. So let me finish.
Why don't you just say it, because this is still being recorded. So for those that are listening, they'll know how to get a hold of you.
Yeah, sure. 253-509-2340.
Okay, that's Rebecca Rainsberger.